closer. You don't have to. If you want to, I don't care if you're on the front row. If you want to leave early, no one's going to call you out. But if you want to just, we can be sort of more intimate, I guess, in terms of the gathering. But I'm Spence Houle. I'm with Diversified Insurance. And I am going to briefly introduce Greg and Scott and then let them kind of take it. They've got a brief kind of presentation, each of them, and tell you a little bit why we invited them to be on this panel. Then we'll have some questions and dialogue, and I think this will be really good. So Scott, by the way, and I met Scott a few years ago. When I first met him, one of the interesting things about Scott's bio is he worked for Arthur Laffer. Do you remember the Laffer curve? 1980s, supply-side economics, Reagan, President Reagan, for those.
You're aging me now.
All right, I'm aging myself.
I remember, Spence.
Thank you, JB. Thank you, JB. But so Scott was in grad school down at USC and was doing some projects for him. And since that time, he's been in finance, working for a number of venture-backed, high-growth companies. You'll recognize backcountry.com on his bio, and then also Count, which is up in Boise. And most recently, and the reason why he's on this panel is not to talk about the Laffer curve, but if you want to mix that in there somewhere, that'd be awesome. Yeah. Is to talk about raising a SPAC and going public with the Mercado Acquisition Partners. And so he's going to talk a little bit about that experience. And then we have Greg Iverson here. And Greg has a strong background too, graduated from the University of Idaho, and has been in finance and accounting, different positions. And the ones that you're going to really jump out, it was University of Phoenix, but they were owned by the Apollo Group,
Education Group, yeah.
Yep, Apollo Education Group. And then he was down in Phoenix for much of his career and then came up here to be the CFO of Overstock, and then most recently with Black Rifle Coffee Company. And the reason why he's on this panel is because he led the de-SPAC process when Black Rifle Coffee Company did a business combination, merged into a SPAC earlier this year. And so without further ado and without delay, let's, I think we're going to have, I think it was Scott go first, right?
Sure.
Is that what my note said? I want to follow the script here. I want to make sure we nail this. So Scott.
Well, the deck is me first, so you're going to
you
have to go with
so
that.
Scott's going to talk about what do you need to know about SPACs and take a few minutes, and then Greg's going to share his experience with Black Rifle Coffee Company's de-SPAC journey, and then we can make it really interactive and ask questions. I've got some questions prepared, but I'd rather hear from you guys and get your thoughts and what you want to talk about. So go ahead, Scott.
Yeah, can you hear me? All right? All right. Like Spence said, I'm working with Mercado Partners, and about 2 years ago, Greg Warnock, who most of you probably know, my partner in this, gave me a call. I was at Count up in Boise, and we had just sold it to Equifax. And as a CFO, you know that if you're a CFO of a private company, for 20 years. At one point, I was a portfolio CFO for one of his companies. And we decided to start the SPAC and take a shot at it. Mercado had been hit up pretty hard by and you have to be super nimble because things have just changed. What a SPAC is, we used to call them reverse mergers back in the dirty old days. The idea behind a SPAC is fairly simple, is that we create a public entity and go out and do an IPO with the intent of ultimately buying a company. Either one or doing a roll-up or doing some sort of form like that. The benefit of it is the SEC the audit requirements are much less because there's not really an operating company behind it. And then ultimately what will happen is that the requirements to get public are fairly simple for the SPAC. And then once they find a target, a la Black Rifle, they would merge that company or buy it, although the entity that they're buying ends up being the operating company at the end of the day. And those of us that were on the SPAC sort of disappear into the twilight or what have you, unless we happen to pick up a board seat here or there. to help out with the company as it moves forward. But it's ultimately the company that they merge with ultimately becomes the operating company for the SPAC. So you still have to go through an S1 application. You got to get approved through the SEC, do an IPO, and the whole 9 yards. I think the interesting thing about the Mercado SPAC was that we filed in April of 2021, which was a week after we filed. The SEC came out and said we needed to change the way that we are accounting for warrants. Now, I'm not going to get into that, obviously. But the issue was that it required a change now to the audit. So it slowed everything down for many months, and we finally got out in the summer, or got ready with that in the summer. The problem then became is that the SPAC market had started becoming very tight. So there's only so many SPAC investors in the universe. And at the time, they were fundamental investors. They were looking for companies to buy and be a part of. And that group of investors had either already had their money in a SPAC because there were so many SPACs out there at the time. I think when we filed, there was 430 or something SPACs. And some of them were sort of well known in the sense of Shaq had a SPAC, Snoop Dogg had a SPAC, Kevin Hart had a SPAC, and then there was me and Greg. And so we didn't quite have the name recognition. Greg had the good hair, but we moved forward and we did our SPAC. And what you saw early on was that the fundamental investors were coming in at first, and they were treating it just like any other investment in a company. They sort of rely on the sponsor group, which is Greg and myself and Mercado, and they invest with the idea that ultimately we're going to find a great company. Now, one of the differences with the SPAC is we raised $230 million. That gets put into trust. Now, that's for the company that we ultimately would buy. We don't actually hand them cash necessarily. It depends on the structure. But we hand them stock in the SPAC. So there's sort of an 80-20 rule, give or take, that if you had $1 billion company, let's say you valued Black Rifle or your target at $1 billion, that 20% of that would go to the SPAC for the cash, and then the operating company would still hold, and their shareholders would hold 80% in this new entity. One of the points that's really important, which is especially important now, is at the end of the day, there's a thing called a redemption vote. Now, all the investors that put their money into the IPO, they get to vote yes or no whether they want to participate. They don't get to vote yes or no on whether or not a merger occurs, but they can say, I vote no, and they get all their money back. So it's sitting in trust right now, and they'll get their money back, and then they go away. So today we have $230 million. If 50% of those investors decided to redeem, it's called, then we would only end up with $100 million that we would be putting into the deal. Now, it changes some of the math, obviously, and whatnot in the deal, but that's sort of the mechanics of it. You do an IPO with a blank shell, with no operating entity. You find a merger. You consummate through just normal process of buying a company. You go out, you get a term sheet, you go through diligence. Ultimately, you have to do an S4 filing, an 8K announcements, and all that sort of thing. And then you go to this redemption. Well, once the SEC approves, you go to the redemption vote. And in the redemption vote, shareholders get to decide, do I get to play or do I not want to play? And so that's sort of the essence of it. The benefits to a company, and I'll let Greg talk more about this, but is they at least get sort of a forecast of what cash looks like. Because of redemptions, in today's market, it's a little bit more dicey in that regard. But it is a way to get public. And then once you're public, you have access to private, to permanent capital, which means you can go out and raise money anytime you need to if you issue shares at the going market price. In some ways, it's a less expensive way to go public, depending on your company and where it's at in its preparation. And it's, in today's market, it's a little quicker process, I think, even though the SEC is trying to slow it up as much as they possibly can. That's sort of the process. The issue is, at this point in time, we've gone through the IPO, we've raised the money, we're in what's called the hunt phase, so we're looking for a company to purchase without getting into any details. We started out with 300 potential targets. We've narrowed that down. We've had about 80 different investor meetings with companies, and we're in that middle of that process right now at this point. I think I'm just going to skip the rest of my slides, mostly because my time's up. And it's more of a content book, so I'll pass it off to Greg here and let him talk about what it's like to be a D-SPAC candidate.
We'll keep those slides close, Scott, because we might want you to revisit some. But Greg, you want to talk
The
about
one of our
the
pictures?
SPAC side?
The one with
I
our
would love to.
pictures on it?
Yeah,
I'd
yeah.
love to.
That's very compelling.
Let me start by reading a 2-page disclaimer.
Oh, yeah, I forgot that. Yeah.
Yeah, I've got a couple slides in here that speak to our SPAC transaction. Before I jump into that, I want to trademarked. But our mission is to serve premium coffee and content to active duty military, to veterans, first responders, and those who love America. We've been able to assemble two public companies. So it's been a fun time here at Black Rifle. Talk a little bit just about what we do. Coffee is the product that it doesn't happen, but we think that our brand really has resonated with a large audience, of course, active duty military veterans, but even broader than that. We're very proud of the coffee that we serve our customers. It's very high quality. And we also refer to our business as being a digitally native omni-channel business. So what does that mean? It means biggest channel for in-home coffee consumption that exists. Most people who drink coffee in home buy it at Walmart, Target, Smith's, the large grocers. So we've gone over the last couple of weeks from not being in a single supermarket or food, drug, and mass shelf to several thousand and growing pretty quickly. From a overall just financial perspective, so I So it allowed us to really pull forward probably a year's worth of demand, so doubled the size of the company, but really came out of the pandemic a very different company with these new channels that I mentioned, the wholesale and the coffee shop. So today we're on track to deliver at least $320 million of revenue for 2022 and $500 million for 2023. Importantly, these are numbers that are above the projections that we provided the street when we went through the SPAC process. So it's been a great story. It's been a great company. Really the highlight of my career thus far. And now you guys know a little more about Black Rifle than you probably did when you came in. So talk a little bit about our SPAC journey, and I can't even read this, and I don't. It's not. And any other sort of intangibles. So we felt very good with the SPAC sponsor who we merged with. One, it was their second SPAC, so they got to screw everything up on the first one and have all those hard lessons learned when they went through the SPAC merger with us. But importantly, they approached it with a couple of unique features. One is they came in with a pre-committed pipe, meaning they had raised additional cash outside. If you fast forward to at the time the SPAC merger closed, the market was collapsing right around us. The market was really strong. Through the end of 2021, started to soften in early 2022. We went public or de-SPAC'd on February 9th, which was a time when the capital markets were absolutely closed. So had we been trying to price a traditional IPO on February 9th, it wouldn't have happened. We may still be private. But because we had raised a $300 million pipe, even though redemptions were relatively high, we were able to, like I said, adequately capitalize the company. And here we are today, a few quarters into it. So it's probably longer than my allotted time.
No, that was perfect. So this is great. And I love the fact that we have two seasoned finance veterans here talking about both the SPAC process and the de-SPAC process. And so I think what we'll do is we'll start with some questions. I'll just kick us off, but I do want you guys in the audience to feel like you can jump in here. But I think you covered, maybe just touch on a little bit more, Greg, about why you guys did the SPAC process or the de-SPAC process versus an IPO. So maybe I've heard the reasons before, but I think it'd be good for people to know that, because sometimes there's, it's kind of like, I remember one time asking, my dad was a life insurance guy, said, what's better, whole life or term? And he said, it depends, right? Yeah. And so it depends on the situation, the circumstance, and a number of things. So talk about that. And then now that you're into this, now being public since February, is there anything you do differently? What advice would you give? What key lessons? And maybe just hit on those two questions.
Mm-hmm. Yeah. In terms of why SPAC, I guess I'll start with reasons why, not the reasons why we did it. And so SPACs have had a reputation for being, one, a faster path to going public, and two, a less expensive. Those were not persuasive factors for us. So not saying that wasn't the case, but those were not our primary motivation. For us, there's really two factors why we chose to go public via SPAC. And I should back up too. So when I joined the company, really my biggest area of focus, the reason why the board and the team hired me, was because I had a background in public companies. I know how not just to get a company public, but to operate effectively as a public company. So we began with that in mind long before we ever selected the vehicle or the mechanism for how we were going to go public. So with that said, the two reasons why we chose to go public via SPAC, number one is the process around how you price the transaction. So in the case of a traditional IPO, you'll hire investment bankers, you'll go through a roadshow process, the investment bankers will build up that book, it's always way oversubscribed, and then if you're scheduled to price on a Wednesday, the pricing committee of investment banks will meet and they'll say, you're going to price it this number, and that's what you more or less have to live with. And there's not a lot of input that the company has in that process, and you're entirely subject to what's happening in the markets. And as we all know, the markets can be choppy, and we didn't like the idea of taking that risk. Some of our investors had taken a number of other companies public, and they've had some situations where they priced IPOs well and some situations where they didn't price IPOs well. So the notion of price discovery, as it's referred to, was really important with us. And so when you think about a SPAC merger, it's mechanically more like an M&A transaction, where you've got the target company and the SPAC sponsor who are negotiating on valuation. You set the valuation, you agree to it, and then it's sort of set in stone. And however the market is trading on the day that you de-SPAC, if you meet the minimum cash condition, if you get the shareholder vote, the transaction will close. So it really de-risked the transaction from a pricing perspective and a market volatility. So that was factor number one. Factor number two is I talked a little bit about our business, but you may have noticed that our company, we have the word rifle in our name. And as you can imagine, when you go out in a investor roadshow, so picture, the private jet to Boston and New York, and you get in front of institutional investors who live in a bit of a bubble, and you're talking about a company who's founded by a veteran with 40 combat deployments. for us, we have an incredible story and an incredible brand in a business, but it's a nuanced one, and it's one that takes usually more than one conversations for folks to understand, particularly those who live on the coast and don't spend a lot of time in the middle part of the country. And so why is that important? Well, if you go public via traditional IPO, you get that one bite at the apple. You get one public company roadshow, and that will determine the book and ultimately the level of interest in your stock. When you go public via SPAC, good news, bad news is you get a lot of time to spend speaking with investors once you've selected your SPAC merger partner. And so we ended up doing three road shows. They were all virtual, but it gave us a chance to really tell our story, which, like I said, was a nuanced one. And it was good that we did, because I think we really needed that time to help educate people on the company, the brand, what we stand for, and what we're here to do. In terms of lessons learned, I think I don't know if there's much that I would say we would do differently if we had to do it over again. So not to pat ourselves in the back too much and do it perfect. We say we did it perfectly, but I think we selected a very high quality SPAC merger partner, and I think that's important, because you spend a lot of time with these people through the SPAC process. Once you de-SPAC, you don't really. The SPAC sponsor still is a shareholder. Usually we'll retain a board seat, maybe more than one board seat, but during that process, from the time that you agree to merge to when you actually complete the merger agreement, it's 7 days a week. You and your SPAC merger partner spend a lot of time together. I think the structure is incredibly important. I think raising a pipe is incredibly important too, as we talked about with redemptions. That's really the big risk in these SPACs, is everybody who invests in a SPAC has the right to have all their capital returned, and they can do it, in the case of our SPAC and probably all others, up to 3 days before the closing. And so if you think about that, you're in a conference room in New York, you're a couple days away from ringing the bell in the New York Stock Exchange, and you don't know what your balance sheet's going to look like after the SPAC, because you don't know what the level of redemptions is going to be until that very last minute. So making sure you've raised a substantial pipe which is not subject to redemption, so that you know you're going to be adequately capitalized, I think is absolutely key. Because what you don't want to do is become public and then need to go and tap the equity markets again, because there's likely not going to be a lot of availability for you. So if we had to do it over again, we do traditional IPO, we do a SPAC. I think net we would do the SPAC, and a lot of it was the fact that we de-SPAC'd, like I said, on February 9th. And if we'd been trying to price a traditional IPO, it wouldn't have happened, just because the markets absolutely collapsed. So it wasn't difficult for us to get the New York Stock Exchange to book us for that opening bell ceremony, because nobody else wanted to be on Wall Street that day.
I had a client that was trying to price that very time, and then they pushed it, and they were going to try to price on Monday, actually, of all things, which was, I think, Valentine's Day, and that was Ukraine Day. So I mean, it was just falling apart for sure.
Worse.
Hey, Scott, talk about, on one of the bullet points in your slide, you said the hunt. So what type of targets you've raised this SPAC, you're looking for a solid company to do a business combination with. What's your appetite? What does that look like? What are you guys thinking in terms of a potential strong target?
Well, it varies, and it varies depending on when the SPAC went out. So if it was 2 years ago, pretty much if there was, a pulse, people were, signing up and de-SPACing companies that had no business. I've seen valuations for companies doing $30 million in revenue and having $1.8 billion valuation. That was 2 years ago. Today, that's not the case anymore. You just don't see that. Today, when we go out, we basically decided Mercado as a firm likes to invest in tech companies or consumer companies. Obviously, Stance and Skull Candy were investments for us, and then a lot of the tech companies that you've seen here local and whatnot. And we like to invest, in Middle America. We've never done a deal on either coast. Doesn't mean we won't, but that was sort of the plan. So we're looking for companies that fit that sort of arena. One of the reasons Mercado started a SPAC was that it's sort of a natural extension. We, as a firm on the private equity side, will invest in companies up to $300 million in valuation. And on the SPAC side, it could be anywhere from $300 million to $3 billion, depending on which company we choose to go after, and of course the state of the markets at the time. The truth of the matter is, it's changed. So I would say a year ago, you could go after a company that was pre-revenue, or unless it, and if it was pre-revenue, it could have, one of the other differences between a SPAC and a regular way IPO is that you can actually utilize forecasts in the company that you're going to acquire as you go out to merge with it. Where in an IPO, once you are public like that, there's very limited use of any sort of forecasting for liability reasons and touting your company reasons and SEC rules around it. So in the old days, you could live off forecasts and whatnot. Now what you're seeing in the SPAC world is there's been, I want to say, 50-something SPACs done this year. What you're seeing now is a tendency to lean more towards the Black Rifle sort of company, which is they have revenue of a certain amount. And in a tech company that is highly leverageable with high margins, you'll see a company in the 50 million plus range, 50 to 100 million in ARR. On the retail side or consumer side, you're looking at companies anywhere from 150 to 300 million is sort of the going place. But if, because of the cash issue in regards to redemptions, you're finding that companies that can go public and are already cash flowing, or at least are EBITDA positive, is sort of what you're seeing right now as far as what's soup du jour for SPACs today. But that's changing over time. You are seeing a lot of deals, though, going out with pre-revenue still. You're seeing a lot of deals in med tech because of the high sort of potential upside in the future. But right now, the market's sort of leaning toward, significant revenue and potentially, EBITDA positive companies. But the SPAC itself can, it just varies. And one of the key points that Greg brought up is it's all about the valuation. That's sort of the key data point in all this, is that the agreement between the SPAC and the target is based on a valuation. The price is $10 a share. That's there. And there's X amount of shares out there. So the valuation now comes into play vis-a-vis how much cash comes in and what kind of, what the company looks at from a cap table perspective post-SPAC.
So if a company wants to access the public markets and for whatever reasons they have, they think, maybe a Jobs Act IPO is not the way to go. I think if you look at Black Rifle's story, really compelling reasons to go the de-SPAC process for the reasons Greg mentioned. So Greg or Scott, the question for you is how, if a company wants to access the capital markets via a de-SPAC process, how best can they do that other than just be cash flow positive and be a good growth company with profitability?
Be worth a lot of money.
I think we get that. Is there anything else that they should do to prepare? I mean, because when companies are thinking about doing an IPO, they're spending 2 or 3 years sort of building out their teams and getting their audits in place and doing that stuff. What beyond just running a good company and being profitable can you share that might be helpful in making them more attractive?
That seems like a you question.
Yeah,
it's a both you question then.
Yeah. I'll give you my perspective.
I can start. So I remember I mentioned this SPAC off process where, we select our investment banks, we prepare a presentation. It includes these forecasts that we discussed, and that's a key difference. When you're the CFO, that's an uncomfortable place to be in because you're now a young company that's growing like crazy, and you're going to give 2 years of forward guidance that then you have to live with. And like for me, having sat in the seat as a public company CFO in the past, you would never ever do that. It's always like the furthest out you'd go is a year, and that's in a much more mature and in a much more stable business. But so I remember probably the first question that one of the SPAC sponsors asked me is the question is where are you at with the audits? I was like, what do you mean? And so their question's really around, it's part of the condition to go public via SPAC is you need to have 2 years of PCOB audits. And so the answer to that question was pretty simple. It's like, yeah, we're done with that. We have 2 years of PCOB audits in hand. What's the next question? But as I went through this process, there was a question we got asked by every single SPAC sponsor. And it made me realize it's like, that's a low hurdle. Like if you're going to become a public company, then you're struggling to get a couple years of PCOB audits, you're going to have a really rude awakening when you find yourself in the public market. So that's something that I'm sure the market has since evolved from, but that's like, like I said, really a low bar. Agree with everything you said in terms of what a company needs to have. The days of pre-revenue companies going public via traditional IPO or SPAC or any way, it's not happening in this environment. I don't know if it ever comes back. If it does, it's probably a good time to be kind of moving out of your position in equities. But yeah, it's like the bar is much higher for companies to be selected as SPAC merger partners. It's got to be a real business. It's got to have real revenue. And even now it has to have, I shouldn't say has to, but more and more needs to have either be currently profitable or have a very clear path to profitability that management can articulate. So I think my counsel to any company who's considering going public, however they're considering it, is the way we approached it from day one. And I just continue to try to pound this message into everyone's heads, but it's not about going public, it's about being public. And you got to begin with that mindset. So sure, going public it's an incredible amount of work, but being public is far more work. And if you're going to go public via SPAC, like I said, you're giving a couple years of forward guidance. You got to have real conviction that you can hit these numbers, because if you come out of the gate and you miss a quarter, you miss 2 quarters, you're dead in the water. You go from $10 to $2, and it can be years before you get yourself out of the penalty box.
Yeah, the only things I'd add probably is, one is that a SPAC is a transaction vehicle. It's a way to get public. I mean, you could go regular way IPO. Those markets are shut down right now. It's just almost impossible to price, as Greg mentioned. The SPAC gives you an ability to go public. There have been 50-something, like I said, SPAC deals done this year, which is sort of in essence 50 companies are now public that weren't at the beginning of the year. But the key point I think that Greg's bringing up is that whether you go IPO, private equity, SPAC, however you're going to fund your company, at the same time, at the end of the day, it's an investment. And it doesn't change just because you went through a SPAC or you're going public or anything else. I.e., the company has to be of value, of real value, and that it's got to be a real company, which an audit is a low bar because it's a really simple checkbox that we've got to do. Now, grant you, there's some nuances in that. But the real thing at the end of the day is, are you in a position where you're going to create a forecast? By the way, the interesting dichotomy here is that you want to create the higher forecast so you can get the better valuation, but at the same time, then you're hooked to those numbers. And in a public setting, that's much more, let's just say, dicey if you don't hit those numbers. In a public setting, private setting, you can go for years missing your numbers, and it may not matter if all of a sudden in year 4 you do well and some strategic comes in. But in a public market, you're judged all the time. So there's a dichotomy in that, but the bottom line is you got to be a company that's going to be profitable one day. At the end of the day, this company has to be able to produce cash flow. And if you can't forecast or tell that story or move forward, or the hurdles are so great. Now, maybe the hurdle is only cash, which is great then, because then if you go public, whether through whichever vehicle, you can get the cash then to move forward in that growth path. But the biggest thing is to build your company foundationally. You got to have a public-ready CFO. You just do. And in fact, that's almost more important today than a public-ready CEO, that you've got to have somebody that the markets can look to, and it's usually the CFO, to say, hey, are these numbers real? Do we have confidence in what you're producing? The SEC investors, they're looking at data, whether it's a 10K or a 10Q or whatever it is, and they've got to know that they've got confidence that the person who prepared that, i.e. the CFO, who, by the way, goes to jail if he did it improperly, did a good job. So you still build your company the same way. Make sure you have a public-ready CFO. Make sure you do audits, and just make sure your house is aligned. If you've got some weird stuff in your business, that skeletons in your closet, then you're going to have to deal with those just like you would in any sort of scenario. Only to keep in mind that as a public company, the transparency is much greater, right? And you've got a much greater audience. You don't have 4 private equity board investors that you got to deal with. You've got a whole market out there that's judging you on a quarterly basis at least, and daily basis more likely. But the last thing I'll mention in all this is that one of the big differences between regular way and SPAC, like I said, is more about transaction. IPOs have actually done worse in this current market than SPACs have done. And that's because it's not that SPACs are a bad way to go. They're just another way to go. It's just that this market's getting pummeled. And a lot of these companies were priced last year, whether they went public through SPAC or regular way. And now they're coming out and getting priced, and they're getting beat up in the marketplace. Black Rifle's a perfect example. I mean, this is a great company, but the market's going up and down with them right now, just like everybody else. So it's nothing new to that. It's just the public market we're in.
Yeah, hey, thanks for sharing that perspective. Questions that any of you have? I've got a few others, but go ahead, Rob.
So speed to market, like walk me through, Scott. So like, what does that look like versus, you know, if you were to say, okay, today I'm going to go ask, you know, just traditional IPO and then versus a SPAC, like what is the actual difference in timing right now? Because it's changed so much.
Why don't you just tell them
Yeah.
on your from term sheet to
Yeah, I'll
de-SPAC?
give you I actually went, I thought somebody would ask that question. It's something I haven't thought about for a while, so I went back in my emails before we came here and looked at when we really launched the process. So from the time I'd say we launched the process in earnest to when we closed was almost exactly 12 months. And so what I mean by that is when we started interviewing advisors, investment bankers, lawyers, et cetera, signed them on, began the SPAC off process, and we actually stopped our SPAC off process pretty quickly because we found a partner and gave them conditional exclusivity. But while we were going through the process, this is when the SEC started to really clamp down on SPACs. We didn't have the warrant issue that you had described. I guess our sponsor went through that. But the SEC was just taking a really critical eye toward SPACs to the S1 filings. And we ended up going through quite a few rounds of SEC comments, and that whole process took a while. So it was a solid 4 months longer than we had expected it to be. I think part of that was just this SEC review and comment process took quite a bit longer. And the other thing too, I should mention too, kind of going back to what we discussed on valuation, that's not intuitive, and I think a lot of folks that we talk to still have a hard time wrapping their head around it. But we were not trying to optimize valuation at the time of the de-SPAC. And that's very unusual. If you think about it, if you're a seller in an M&A process, when would we ever not try to optimize valuation at the time of exit? I can't think of a situation. And it's for us, it's like we approach this really as an IPO, not as a typical de-SPAC. And so we had initially reached an agreement with our SPAC sponsor at a $2.3 billion valuation. And we agreed to lower that valuation to $1.7 billion, which has real economic consequences. Why would we do that? It was us just making sure we could position ourselves for success, where the stock wouldn't just say sit at $10 or trade down from $10, but it would have some significant room to appreciate. This is typical in a traditional IPO where you'd have this pricing committee that would set it below what the bankers think the value is going to be, so all those initial investors get a pop. I think that was something that we probably lost a month in the process, because that's not a decision you take lightly, to basically give away $600 million in value. But with hindsight, ended up being, I think, a really good decision.
Quick question. Term sheet to de-SPAC, how long?
Term sheet to de-SPAC.
Because SPAC offs are not necessarily the
No.
only way you see this.
I think, I'd have to go back and look, but I think it's probably around 7 months.
Yeah, that sounds about right. I'd say 7's probably a good number. And most of that, it has a lot to do with the rounds with the SEC. One point on valuation. And this goes in any kind of negotiating you're going through. The tendency is to think the higher the valuation, the better, because the less dilution. In a public market in particular, the reason that's not always the best route to take is that the public market will value you. And if you are overvalued, whether it's through regular way, SPAC, or whatever, the market's going to immediately start to price to you to what you should be selling at. And all of a sudden, though you may have less the dilution was less, the pricing differences and momentum is a big thing in public markets. So once a stock starts to go one direction, it tends to be hurt, pretty badly over time. So, I mean, pricing is a very deliberate thing, but, the natural tendency is to think that, the more valuation, the better. But that's not always the case. It's sort of like when your neighbor tells you, I don't want to sell my home yet because I can't get what it's worth. Well, the truth is you can only get what it's worth, because that's what people are willing to pay for. And the public markets will set you based on the comps and the world and how it looks at it on the value of your company. If you overvalue it, it's going to take a hit in the public market almost immediately. And so the benefit you got from dilution, that gets pounded in valuation as well.
Go ahead, Kendall.
Yeah, Greg, now with the benefit of hindsight,
anything that you would do differently, anything that you change, any kind of big issues that now you've got the benefit of that hindsight you would do differently?
They should have chosen us as a SPAC
Yeah,
partner.
other than that, yeah. Other than that,
Would have made my life easier.
yeah. I don't think if I turn the clock back, there's necessarily things that I would have done differently. But what I will say is the market for SPACs changed a lot while we went through the process, and the perception of SPACs changed a lot over through that time as well. So things that are, say, different now than what I had expected. I mean, certainly one was the level of redemptions. And so while we were going through the process up through close, we had traded really well. We'd consistently traded above $10 a share, and all expectations were that we were going to have 0 redemptions. And then, like I said, the market really fell apart in January and February. We went from a little bit above 10 to kind of at 10 to about 996, which is about sort of the floor for a SPAC, because like I said, somebody can always go and get their money back. So we ended up having about 70% redemptions, which is so much more than we expected. And like I said, you go through this process months and months and months, and everything looks great, and then the market falls apart around you, and now your balance sheet's going to look a lot different. So for us, what does that mean? We still put $150 million of cash on balance sheet, but had there been no redemptions, it would have been $225. We had very minimal secondary selling, which was fine. We didn't have our investor group looking for a lot of liquidity. But I think the bigger thing is your investor base coming out of the SPAC ends up looking quite a bit different than what you thought. And so I mentioned we went through multiple roadshows. You get in front of a lot of investors. They may be taking positions, but there's so much churn in your investor base. And so by the time you de-SPAC, other than your PIPE investors end up being very, very important, especially if they take a long-term view. But I spend a lot of my time now, basically, it's like from the time we file our 10Q to when we enter our quiet period, we are on the road. And that's where we were on the road the last couple of weeks, getting in front of investors, because we need to continue to bring new names into our stock and continue to bring more, long-only institutional investors and fewer hedge funds. And so there's a lot of, I guess I might call it, cleanup work that you have to do after going through the process. That was not something that we had necessarily anticipated. And the other thing that's been interesting as well is, I mentioned being on the road the last couple of weeks, every investor meeting we take, the topic of being a SPAC or a de-SPAC comes up. And the expectation from our advisors and everybody else is nobody cares how you go public. Once you're public, you're public. And it's all about delivering. And I think that was true up until recently, but it's a bit of an unfair thing. Like you mentioned, it's like if you look at the basket of companies that went public via SPAC in 21 versus the traditional IPOs, I mean, these traditional IPOs, especially in the consumer space, are absolutely struggling. All the companies that we watched who weren't in the coffee industry necessarily, but were in the consumer space, they've had a really, 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 really tough time. So it's I think that will pass. It's like any newly public company. The market's going to look at you with some skepticism, and it takes a few quarters of delivering on your numbers, and then folks will start to take you more seriously.
Good. Well, hey, so our clock, we have this little clock up here that tells us how much time. It says 6:45, but I think we're supposed to end at 1:20. It's 1:21. I'm not sure if they set this later. Maybe we take one more question and then wrap up. If anybody has a question, go ahead back there.
Yeah, I've got one. The fees associated with SPAC and de-SPACing versus doing an IPO. Have you done analysis on that?
Yeah, they're different, but they're different more in their makeup than they are ultimately. It also is dependent upon how much you raise and all that. So it differs. I mean, some of the bigger, anytime you get into the bigger number from a percentage standpoint, those fees look smaller. If you're a $300 million valuation, it's much different than if you're a 2.3 or $1.7 billion valuation. As far as the fees go, I would suggest that it's a little bit cheaper going through a SPAC, just based on how much ends up on the balance sheet vis-a-vis. Plus the actual process itself is usually cheaper. It's a shorter process and there's less involved. But I don't know if it's significantly different. I don't know what your experience was.
Yeah, I guess it's up here on the slide. So you can see our transaction expense is $51 million. So it's an expensive process. Going public is expensive, whether you go traditional IPO or SPAC. So be prepared to spend a lot of money either way. Is one more expensive than the other? It probably depends. We weren't. So like I said, we weren't looking for the cheapest route. We weren't looking for the fastest route. We were looking for the best route, and we're willing to pay money to get there under the terms that we wanted. We hired really good advisors. We partnered with a good SPAC sponsor. We continue to work with good advisors like our friends at Diversified Insurance.
I put that in there. These guys are both clients, so make sure you plug us.
Yeah.
It's just a little self-promotion.
And so yeah, it's like I'm in agreement with what you said. It's like I don't know if there's necessarily one you can point to that's more or less expensive, but I think if somebody's looking, if their sole focus is getting public the cheapest way possible, I don't know if that's the right objective.
Yeah. I would just add that a lot of those expenses are success fee based, a great, huge part of that. So if you never get to the public part of it, it won't cost you $50 million, but it's going to cost you millions for sure.
One bright spot on expenses is, and you guys, this will be near and dear to your heart, because D&O insurance was super expensive the last couple of years.
Yeah, now you tell me.
Companies going public, and what we're seeing, companies that went public or de-SPAC'd in 2021 or earlier this year when you guys did it, now their renewals, they're seeing 20 to 50% reductions in premiums. So
Timing's everything.
That's going to help on timing is everything. That's helping on expenses. And part of the reason is these insurance companies have built up this capacity because there was so much demand over the last few years.
Yeah.
That demand just went down a cliff with the securities market drying up in the United States. And so you have less demand, a lot of capacity, and companies fighting over legacy companies. And those companies that paid a higher premium last year are getting a benefit this year on a nice material reduction.
Does that mean we got credits coming?
No credits. Easy there, Scott. Hey, great conversation. Really want to thank Scott and Greg to share their perspectives and insights. A ton of talent between the two of them. Definitely, I know they're going to be around here for a little bit longer if you want to come chat with them a little bit or get a little bit more knowledge from them. But we're going to wrap up because I'm not sure which clock to go by, but we're either ending 3 minutes and 2 seconds early or 2 minutes late. I don't know. But thanks, you guys, and enjoy the conference. Hey, thanks for
Thank you.
doing this.
Nicely moderated.
Oh, hey,
Yeah, way to moderate, Spence.
jeez,
You're the man.
you are welcome. Yeah, you guys-
Your movie star brother would be proud of you.
I know. I'm not quite on the Netflix level, but he is. But it's insurance.
This was fun. Yeah, well, that's great. It's good to meet you.
Yeah, thanks for doing this.
It
Good.
is true, when we de-SPAC'd we IPO'd in November. Now, of course, you guys were 90% of the way down the road.
Yeah.
But you guys, your name came up almost as like B
I'm
of A's
sure.
first comment it was before you announced.
Oh, yeah. No,
But
it'd
they're
be
like,
perfect.
you
yeah.
guys, these guys would be
Hey,
perfect. And you guys were the
That would be
perfect
terrific.
target.